Good morning, America. Thank you for watching here at Taxes Made Easy. We've got an interesting topic today. We're going to talk about the home exclusions. So, how do you really benefit from it? How do you make sure it works for you? So, again, investing in real estate and in your primary residence can really help you out. But again, you need a plan to make these decisions. And unfortunately, there's people that either don't understand how to make this work, or they know a little bit but not enough to make sure they do it right. So again, this is an important topic dealing with one of your biggest assets, and I've seen this blow up in people's faces too many times. So again, with a little bit of proper planning, it can make you a lot of money. So stay tuned. There's a lot of news to cover, but excited for our topic for the day. And thank you for watching live on rebroadcast, and we'll be right back. Welcome back, everybody. Thank you for watching Taxes Made Easy here on smartmoneyculture.tv. And we've got a lot of interesting news dealing with different tax proposals, and these vary throughout the country. And you're seeing, again, every year, you see budget proposals by state. And I think it's interesting to note the difference in plans happening across the country. So we have three stories, one in Pennsylvania, one in Florida, and one in San Francisco. So Pennsylvania being more of a purple area. Where are people going with cutting taxes, and what are the ideas here? So some of the ideas happening here across the country. And it's important to be informed as to what your local representatives are planning and thinking so you can get involved. Local politics is something most Americans do not get very involved in at all, but sometimes that can affect you much bigger than a presidential election, believe it or not. So if you're not involved or don't know what's happening locally, I would encourage you to get involved, or at least find out what's going on so you know who to support, who not to support, and what policies will help and or hurt you. So the first article here is from Pennsylvania, and this is from the Associated Press. So you have two competing plans here. Apparently they have a $14 billion budget surplus, and so the Senate is controlled by the GOP, the House is controlled by the Democrats, and the governor is Democrat. So you have competing plans. The problem is, because you have a split legislature like this, you have to negotiate. You have to come to the middle somewhere. And so the governor came out with a bill, and this is the government right here, Josh Shapiro. He came out with the idea of, let's use the money for underfunded schools, other areas, which is a very noble idea. And the criticism being that is, look, we're increasing spending, whereas this is a one-time thing. Leftover COVID funds is one of the biggest reasons why they have this money. But they have this surplus of money. Do we use this to fund projects that we're not going to be able to afford a long time? Or do we use this to help everybody by cutting taxes and hopefully increase the tax base over time, ironically, by cutting it? So those are really the two plans being proposed. One of the things that I mentioned, and again, just going to this, one of the things I want to mention, supporting Mr. Shapiro's plan to spend, there's a paragraph in here where the court found, here we go, last year's court decision found that Pennsylvania's system of funding public schools violated the constitutional rights of students in poor districts. So personally, I think it's a shame how inner city areas, poor districts, struggle for funding, how some of these schools are just in school districts are horribly rated. Throwing money at issues, though, isn't necessarily the answer. It can be, But again, as we've seen in many places where we just increase funding and throw more money without any kind of accountability, it doesn't improve the school systems at all. It can exacerbate it. That's another. It's a whole other can of worms. They had an article yesterday from the Chicago Teachers Union demanding, I think it was 50 billion in increased wages and benefits. And the numbers, Chicago School District is one of the worst in the country as far as actual educational results. It's absolutely atrocious, between 14 and 16%. So again, I like the idea of giving more money to poor schools. Who doesn't? But at the same time, what they really should be looking for is actual results, not just giving money out. So it's, and the problem is if you increase funding without, long term, this is a short term budget. Once they use this money, it's going to be gone. So how do you use it for long term growth? Republicans argue tax cuts. So again, cutting the personal tax rate from 3 back to 2.8 level, 3.07% down to 2.8%, where it was before it was raised in 2003. So, it's a 2% difference. It does put money back in the pockets of average citizens. But again, you get these competing desires. The knee-jerk reaction from the Republicans is to cut taxes. Let's give this money back to the people. But again, the Democrat argument is, look, if we cut taxes, it's going to cause fiscal problems in the long run unless there's growth that goes with it. So, not sure which one is the right way to go. There are arguments for both sides here, but we should be aware of what's happening, what their arguments are, and what do our communities need. So jumping to the next one here, goes to Florida. Of course, Florida is controlled by Ron DeSantis as the governor, very heavily Republican. And what are they doing? Cutting taxes, toll reduction, disaster preparedness. Again, some of this is short term. Provide over $1 billion in tax relief for Florida families. When you spread that out, it's probably not that much. But again, back to school tax relief to allow people to buy school supplies without any tax. Disaster preparedness tax holiday. So disaster preparedness tax holiday. It will allow you to buy supplies that are needed that are needed tax-free. And then he's also talking about other things, a Freedom Month where recreational items are tax-free. You encourage people to get out there and participate and be involved in healthy activities. So, well, that all sounds good. Most of it doesn't look like it's really going to grow, maybe increase purchases and people to spend money during these time periods. But I think one thing that really stood out was businesses that hire Floridians with disabilities will be granted a 3-year corporate tax income credit of $5 million per year. And that's amazing. Anything where, again, the disabled community really is hurt or does not get enough funding, and providing jobs and encouraging employers to hire people with disabilities, for jobs they can do, I think is great. I think that's a good way to go. So last article here, and this is from the San Francisco Chronicle. The previous article was from a local news station. And I think this is interesting. What is San Francisco talking about doing? Cutting taxes. So again, San Francisco has one of the slowest recoveries of major cities from the pandemic. Why? Because they have the highest tax rate in the country, or one of the highest tax rates of it. So again, they want to do a sweeping tax overhaul. Part of the problem is their current tax rate relies on major tech companies in that area. I think it's about five of them that provide most of the tax base. Problem is, one of them sneezes, one of them moves out. Someone gets upset with someone. It can really devastate an economy that's reliant on these larger corporations. So they want to ease the tax burden for small businesses, but also spread it out. So this is interesting that here in San Francisco, you have both. So it's the highest tax rate of any California city, but also one of the slowest pandemic recoveries. So again, people doing remote work cost the city $484 million lost tax revenue, and that trend is continuing. And so they still have plenty of expenses, so they're recognizing that they need to do something. And here we go. I think this is key here. So the urgency to address this and actually make long-term fixes to their taxation, that makes sense. Has the support of both candidates for mayor, London Breed and Aaron Peskin. So I think when you have common sense decisions to make, it would have make sense to do this sooner, but it looks like they're both on board to make common sense decisions and overall helping small businesses. Overall, most people are going to see tax cuts. Or again, some people they're changing how they're doing it, where instead of taxing employment, they're going to tax sales. So, and do a flat tax revenue. So flat tax is actually a very libertarian idea, a very conservative idea. And this is just on a minor twist, but again, I hope this works out for San Francisco. And this is why we have local politics, local decision makers looking at what makes for their sense, and they can try things. And we can see if, hey, does this really work? And so it looks like politically they're all on board to try to make this happen. They have to get the signatures, put it on the November 5th ballot, so they have some hoops to jump through. But one of the concerns here, if this is not passed, it gets more into the details, but if it doesn't get passed, the current tax break in place for small businesses is going to expire at the end of the year, and taxes will go up, hurting small businesses. So again, that's something nobody wants in San Francisco. And between the two mayoral candidates, they're both trying to come together and get this passed for the benefit of San Franciscans. So I think it's an interesting take. Good information to have. And so we've got some more general economic news coming up. But I do think that's really interesting to understand what's happening locally, what are current trends out there, and I would encourage you to be informed about what's happening in your state, but also your county. What's going on? What kind of proposals do they have? Do you have a business-friendly climate? Do you have more investment in poor communities? So get informed, and we'll be right back after this next break. Welcome back, everybody, and we're going to shift topics a bit and really go into look at on a larger macro scale what's happening in the larger country. I thought it was ironic. I saw a cartoon talking about the Biden's proposed tax increases. So basically letting the Trump ones expire and hitting the richest in our country with a lot more in taxes. So that's opposite of what everybody else is saying we should do. Opposing ideas. I think it's good to have opposing ideas, and I'm glad that they actually came out, the Biden administration came out and talked about it, so people can look at it and say, okay, well, does this make sense for where the country is going or not? Before that, they were saying that they were going to keep pretty much all the Trump tax cuts in place. But yeah, I'm glad there's some clear difference, and people can actually study up and make a decision as to what they think is best for the country. So again, we have an article, and we've talked about this before, but I think it bears highlighting. Looking at the full-time jobs. So the latest jobs number was disappointing. It says the U.S. economy added 175,000 jobs for the month of April, which was, and unemployment went up to 3.9%. So if we're adding jobs, and again, the population is increasing, we're letting people come into the country in the hundreds of thousands. So that's why even though the total number of jobs are going up, the number of jobless, well, the unemployment rate is going up 3.9%. What I like about this article is that they really dig into the numbers and explain what's actually going on. So the whole premise of this article is that full-time jobs are actually decreasing while the total number of jobs are going up. How does that make sense? So you have the way the government runs a survey, and then if you run a household survey, it's very different. So this has to do with part-time jobs. So the total amount of jobs increasing, the 175,000 in job creation that they're looking at, looks at part-time and full-time jobs. And so this is what we've been seeing in the economy, that for the last, and these numbers are very, very hard to read. So you have the main number that the government uses, because why do they use those numbers? Because they look better for them. And so try to get in here and see it a little bit clearer. There we go. So these numbers are still small, but I can read them off to you. So this really is month by month from January 1st of 2021 all the way to April 1st, 2001. So again, this is what we want to see, is real numbers of people employed. So this is why, even though jobs went up by 175,000 over the last year or so, I'm really going back to August of 2003, July, August of September 3, the number of full-time of a household with someone being employed has pretty much stayed the same and hasn't increased. And that's over the last year and a half. And this is what this article is arguing, is that, look, full-time employment went up a little bit, but it really hasn't gone up in the last year and a half, while the total number of jobs have continued to increase. So how does that make sense? And it's because you're getting part-time jobs, not full-time jobs. So let's go back to the article. So this is their whole argument, that there's an actual recession in full-time jobs. These are 0 to no growth. And when you have that factor in the increase in population, that naturally happens. This is why these numbers are very accurate. So understanding the government numbers and where they're coming from is very important. So total number of employed persons has stagnated or staying the same, and the total number of jobs created was 1.8 million. And again, this is due to part-time job growth. Over the last 12 months, we've got 1 million more part-time jobs, but full-time jobs fell by 500,000. Yesterday, I was speaking to someone that's struggling, and they were struggling to get a job, and they had 2 part-time jobs. And then we're able to get a full-time job, and to get caught up on bills and get back on our feet, she's planning on working at least 2 jobs, if not 3. This is what we're showing A lot of people have picked up extra work just trying to make it in this tough economy. That's not real growth. That doesn't show a robust economy. It shows that people are hurting. So again, this is total growth and total employed. And it's gone up in the last few months especially. It's dropped sharply. So these are part-time jobs, whereas over the same period as the other graph, it really has just leveled out for full-time jobs. And from the high, it's actually gone down substantially. So that is frustrating to see, and explains why people are hurting this economy. So again, it dives into the charts more, but I'm gonna we get the gist of what the article is saying, and we're gonna jump to the next one. This is going to Fox Business, and this is again, we have different Fed presidents or people in different cities that are saying different things. And this is why it's so hard to know what the economy, what the Federal Reserve is going to do. And while he says monetary policy is in a very good place, that interest rate cuts will happen eventually, this flies in the face of what the Fed president in Chicago is saying. And so, again, he wants to be rosy. He wants to say, look, the time to cut rates aren't now, but if they want to cut rates, he just didn't specify when. And he says eventually we'll have to cut rates. But if the economy and inflation continues, if we don't have true job growth and people are continuing to struggle in the economy, cutting the interest rates isn't going to improve the situation. It's going to make it worse. And you might ask why? Because we're in this place. We're in this situation because Democrat and Republican alike, they love the easy money policies of the last 20 years, having very low interest rates. That's why people were able to get such low interest rates for real estate, etc. But it wasn't healthy. It was the Fed distorting the market, playing with the numbers because it looked good for the time. And so now we're paying the piper, we're paying the price. Like I said, there's no free lunch. And again, you have these national geniuses, or supposedly geniuses, that they keep saying they want to cut interest rates. But when you cut interest rates and you already have high inflation, that just fuels more inflation. Adds more fuel. It's like pouring gasoline on a fire. So that's why I think they should be very cautious. They should actually look at the actual numbers of what's happening in the economy rather than just doing what feels good in the moment. So the markets overall really paying attention to what people are what the Fed is saying, what they're doing. And I think it's helpful to understand how this affects you and your personal bill. So if they, by cutting interest rates, they're essentially allowing for more money to flow into the economy. But if you have more money and you don't have productivity go with it, that means it's just going to drive up the price. You have more dollars chasing the same amount of goods, and it just drives up the price. So that's why we really need to focus not just on monetary policy and making some little adjustments here and there, but we really should try to be increasing the overall productivity of our country, strengthening the underlying, the not just money, numbers, and interest, but actual growth. And that's my big concern with looking at raising taxes across the board. That's a very anti-growth policy and can hurt a lot of people. And so a lot of people I know and I see are holding their nose, hoping that things change with the new presidency and that the economy starts turning around. It's not going to turn around right away, and the damage that we're doing to the economy with really high interest rates and poor fiscal policy. I mean, he says they have good fiscal policy. I don't know what that guy. I mean, he's definitely just kind of parroting what the government's saying because we're overspending like crazy. We do not have good fiscal policy in our government, and we haven't. Like I said, pretty much going all the way back to the Clinton era and Newt Gingrich's contract with America. That's the last time we were not digging a deeper hole with our budget. So one of the biggest things that affect people, and this is what I want to focus on as the topic for the day, is home ownership. So home ownership is the biggest indication. This is a CNBC article. I thought this was very informative. Home ownership is a great way to create wealth. It's a great way to create long-term stability, to support yourselves in retirement when you pay off a mortgage and you can retire. That's one of the big goals. That's part of the American dream, where you can afford a home. But this is why when people retire and are on a fixed income, this is why rising property taxes can hurt homeowners so bad. So how do you make money off of home ownership? The capital gains exclusion for homeowners is the best way to do this. So I've got plenty of stories of how people did this the wrong way. So again, I think, and I would highly advise, whenever you're considering selling, talk to a tax professional well in advance. Don't do it at that moment. Don't use TurboTax or H&R Block. Sorry, H&R Block and TurboTax. I've seen too many people hurt by doing major moves. If you just have a simple W-2 income, that's fine. But if you're going to sell your home, you need to talk to someone. And there's plenty of excellent CPAs and tax preparers out there that have decades of experience dealing with these kinds of issues. But you need to make sure you're doing this right. So first horror story. This actually turned out well, but this gal called in, and she had sold her home in Ohio and decided to move to warmer climes in Arizona. You got tired of shoveling snow in the winter, and you're a single elderly lady. So she sold her home. In her words, she used a program cheaper than TurboTax. And then, lo and behold, she got a tax bill for $113,000. Blew her mind. How in the world did this happen? So, a couple issues here. When we looked at the return and we were talking, I was like, look, we could do an offer and compromise for us, but we'd have to charge, because it's a 9 to 12 month process, we would charge you a few $1,000s to do it. But we could settle this whole balance for very low amount, but there might be an easier way to do this. And we always try to do that for our clients. So we looked at the case, and I started asking questions about this tax bill. She had sold her home for around $350,000. Didn't put on there that she still owed about $150,000 in a mortgage, and didn't claim the exemption for capital gains taxes. So I said, look, you don't need to hire us to go in and do a resolution and do an offer and compromise with the IRS. All you need to do is amend your tax return. We referred her to a CPA that we know and trust. He amended her return, probably charged her a couple $100s to amend the return. And that $113,000 bill went to zero. So if you're not familiar with this, this is absolutely key. First of all, the key points here, and I like how they lay this out nicely. It's a $500,000 exemption for married and $250,000 for single filers. So the way this works, if you go and you purchase a home for today, let's say you go out and you purchase it for $400,000. The idea behind this is that if you wait 10 years and your home increases to $800,000, If you were to sell your home for 800,000, doesn't mean you have any more house, but the market has changed, the values have changed, and then you're going to need most of that money just to buy another comparable home. But that does create equity, and that's money that you can put down on a home. But it's to help people when you're going from one residence to another to save money and be able to purchase a similar home without paying huge taxes on a primary residence. So again, in 2023, nearly 8% of U.S. home sales yielded profits exceeding 500,000, and that's because home values have shot up through the roof, and a lot of people are thrilled. Yay, that's great. But the problem is, if they shoot up above 500,000, then you're going to get hit with taxes. Whereas in 2019, only 3% of homes exceeded that amount. Most people sold their homes, didn't have to worry about paying any capital gains on those. So, and this is going to suggest ways to add to the basis of the home. So we're going to talk about these different things. My main point, and what I want people to take away from this, if you're considering selling your home, plan. Plan before you do it. Go talk to a CPA. Go talk to a tax professional and tax preparer, someone that knows and understands this. And so when you go talk to someone, you need to ask questions. Hey, are you familiar with the sale of homes, capital gains, etc.? Anybody that's been around the block, they've been around for a while, should absolutely know this. If they're not sure, get a second opinion. Go check with someone else. So this is a great way to build wealth for you and your family, but it's also a great way to save you a lot of money with the sale of your home, especially if you've been in it for quite a while. And we're coming up on another break in about another minute. So I just want to talk about it. So when you sell your home for more than you paid for, more than the mortgage, you have what's called basis. Basis is if you go and let's say you don't purchase the home, but you go build the home. And let's say it's a $500,000 home, but you spent $400,000 building the home. It's not right for the IRS to come and tax you on the full $500,000 when it cost you $400,000 to build it. So that money that you put into your home for capital improvements to the home is considered part of the basis, and you can go and adjust that to lower. You can have a nicer home, and it can lower how much you're going to sell, what your taxable amount is going to be. So tracking your basis with capital improvements can absolutely help improve that. So we'll be right back after this break and continue the conversation. Welcome back, everybody, to Taxes Made Easy. Continue the conversation here about home property. So selling your home and your primary residence. So again, there's some key information here that you need to know about this, and you have to qualify for it. So just continue with the article here. One of the things it points out is this 500,000, 250,000 numbers hasn't changed since 1997. Inflation has changed drastically, but those numbers have not changed. So with home prices exploding, more and more people are getting caught in this, and owing money on the sale of their home. So if you owe, so for example, when you sell home and you sell property, first of all, I've seen this too many times. I'm getting a little bit ahead of myself. Where people end up owing because it's not done right, and it's done, you end up owing quite a bit. So if it's over 500,000 for a single file, it's 20% tax. It's a little bit higher for married filing jointly, but you pay 0% tax from 47 to 94,000, but then it goes up to 15% for the second bracket, and then 20% for over that amount. So it's very easy to end up in these categories. This is why this gal that sold her home for $350,000, her tax rate went up through the roof. She was paying 15% on that plus penalties and fees for $350,000 because she didn't do it correctly. And again, she just had a small home that she sold. When people have larger, more expensive homes and they move, if you don't do it correctly, it can really hurt you. So again, this is happening most often in high-cost areas: Colorado, Massachusetts, New Jersey, New York, Washington, California. So these are the areas that are getting hit the hardest by this. So if you're planning on selling your home, first of all, you need to make sure that you qualify. So again, if you're not sure, it absolutely would pay to go sit down with a tax professional and make sure you qualify. So you have to own the home for at least 2 of the past 5 years before your home sale. So then you have a residency test as well, and this puts it at 24 months of the 5 years before the sale. So, and then you have to wait so long before you can use this exemption again. I believe it's 5 years. But every 5 years, a lot of people will purchase second homes and live in it for a while, long enough to qualify for the exemption and turn around and sell it. And again, that can bring some huge tax savings. But how do you reduce your capital gains tax bill? So first of all, you want to plan and make sure that you qualify for it, that you meet the ownership and residence test. And then if you do think you're going to have a tax bill, a big part of this is people don't keep good records over time. And this is where being organized and planning things out is absolutely key. So, and this is very important. This is something that you've probably already done, and if you don't keep track of it, you're not going to get the benefits. So if you've lived in a home long enough where it has enough equity, has enough home value, where if you sell, you're going to have capital gains, you've made improvements to your home over this time period. Almost always you have to fix the roof, you have to improve things, and this all can go to the basis of your home. So if you paid $200,000 for a home and you sell it for $500,000, that's a gap of $250,000 there, or $300,000. But if you've made improvements of that to the home, and so it's like, let's say you're a single individual, you bought the home for $200,000, you're selling it for $500,000, only $250,000 is exempted. You can fix that by keeping track of major improvements, and that gets added to the basis of your home. So if you redo the kitchen, you redo the roof, let's say you add over 10 years, you added $100,000 to the basis of the home. If you track that and prove that to the IRS, you can now say that your basis is $300,000, not the $200,000 you paid for the home, and so that reduces your any taxes. So it takes your capital gains to zero again with the $250,000 exemption. So routine maintenance don't count. What does count? Cost of a new roof or an addition, or redoing the kitchen, bathrooms. Again, you want to talk to a professional, and I would do this sooner rather than later. Most people will eventually sell their home, and you can just take these receipts for larger purchases, make sure they're labeled correctly, and just save them. When you go to sell your home, you can pull all these out, and it can save you tens of thousands of dollars. So when you sell your home, again, you should get a Form 1099-S for real estate transactions. One of the biggest problems I see is people either don't get this form, maybe it was sent to the wrong location, etc., And again, this creates a lot of problems because sale of real property, it's in the hundreds of thousands of dollars. It all is going to be reported to the IRS. So I'm going to jump to an IRS article that talks exactly about this. This is from irs.gov, topic number 701, sale of your home. This is right on point. And so this is how you, if you're a primary resident or not, you should get, and then you have any kind of sale of property, make sure that this goes on your tax returns. Believe it or not, we've helped plenty of people where a home, real property has been sold. They didn't get the paperwork, and so that information did not get communicated to their tax preparer. That in sale of the home was not reported on the return, but the IRS has all that information. That is so easy for the IRS to pick up on that and issue a notice of deficiency and tack on penalties and interest as well as the total debt. So like most situations, the IRS gets the amount of the total sale. Will they automatically give you the exclusion? No. You have to qualify for it. So you have to report the sale. You have to use Schedule D, capital gains and losses, or Form 8949 sale to report the sale and get the exclusion plus any improvements in basis. So again, their test here is a little different from the article I just read. So this is why it's so important to talk to a tax professional that's up to date on these requirements. But again, it just kind of walks you through. You should get this 1099-S. If you don't receive it, what are you supposed to do? You could always pull your transcripts. After about May or so, the end of May is when you should be able to pull your transcripts. So you file for an extension, make sure your taxes are paid by April 15th, but file for an extension, and then you can pull the IRS transcripts and report that. The IRS transcripts will have everything that's reported to them by that date. Or you can report it in a different way, and again, talk to a tax professional about this. But if whoever you're working with, they don't do it, you should follow up with them and make sure, hey, where's the 1099 for this? I need to report this, and make sure it's done right. Because this is huge tax bills come from property sales not being reported and not being done correctly, and we see this too often. So again, you have to report it on your 1040 with these different forms, and there's some exceptions here. So if you have someone on extended duty for the military or other uniformed services, or foreign service or intelligence community, you can suspend the 5-year test for up to 10 years. So if you live there and you use the home periodically, up to 10 years, you can still qualify for it. But again, you have to qualify for this exemption. The IRS is not going to automatically give you any of these breaks. You have to apply for it. And then if you have a home being sold on installments. So again, to kind of wrap things up, your home is most likely your biggest investment. There are a lot of ways it can help you. Pardon me. Interest payments can be deducted, and if it can help you itemize your taxes rather than claim the standard deduction if you're paying enough. Most home selling today, you're paying a lot more than you were before, and even though the standard deductions are going up, if you can itemize, that's a huge help for many taxpayers. It creates wealth instead of renting and just paying if you're paying similar amounts for rent versus home ownership. And if the interest rates go down, one day they might, if we get our fiscal house in order, you can always refinance and get a lower interest rate on your home. So there's a lot of benefits to home ownership. Again, it's more expensive now than ever. But when you use the tax rules in your advantage, in your favor, it can absolutely benefit you. And if you don't know them, they will hurt you. to no end, and we're talking hundreds of thousands of tax liability. And just because somebody missed the window, they missed the exclusion. So this is why it's so important to understand what the requirements are for these exclusions, understand what needs to be done and how do you qualify for it. And so that way, when you do make major life decisions, you're doing this in an informed manner. Most people do not plan their lives around taxes. And that's just reality. But if you get a little bit of advice, it can save you, like I said, tens of thousands, if not hundreds of thousands of dollars, especially with your largest asset, your home. So take a moment, sit down with somebody, discuss it, look back, and if you can pull receipts and proof for some major improvements you've done, talk to a tax professional and see what qualifies as a capital improvement that can be added to your basis, and you can use that years down the road when you sell your home, and what doesn't. Most people don't take very good notes. They don't save receipts. They don't keep track of it. And so what happens to all these tax savings? They get wasted. That's what typically happens. But if you keep track of it, you keep good records of it, and you understand what you need to save and what can help you down the road, it can help you save tens of thousands of dollars. And in my book, that's worth it in most cases. So get informed. And part of this, part of what we're talking about is helping people make wise financial decisions, use the tax code to their advantage. And, this is what wealthy Americans do. This is how people become wealthy, is understanding tax laws, understanding what are good investments, what aren't. Home ownership is not always the best investment. It's usually better than renting, but, there's been arguments going back and forth on that. But by understanding how taxation works, especially with one of your largest assets, your home, it can save you a lot of money. So get out there, connect with a CPA, connect with a tax preparer. If you need someone, we can refer you to excellent CPAs, and talk to someone that just doesn't, too many people, they go in, they take their tax returns, they dump it on them, and they never talk to their CPA again all year. They just talk to them at tax time, and if they're too busy, they'll just send in the documents, won't even discuss their tax returns with them. You should go and talk to them throughout the year. Ask them these questions. Say, hey, how do I prepare for this? My kids are leaving the home. We're thinking of downsizing. We're thinking of doing this or that. How do we prepare to save a lot of money on any potential sale of our home? And sometimes things happen. My bishop at my church, he wasn't planning on moving. He had a good job. He was well settled. He had been there for 15 plus years in his home. Very happy, no plans to move. His daughter actually went to college and left, so they didn't have an immediate family holding him there. But then there was an emergency in their family. His wife's parents got very sick, and they needed them close by to take care of them. So at a moment's notice, they sold their home, moved all the way up to Utah. The problem there being, was there any tax planning that went into it? Were they prepared at all? No, because life happened, and they did what they needed to do to be there for family. Commendable to them. Great. But if you plan and you understand what you need to do, you can already have things ready for when you eventually sell your home. And sooner or later, most homes are sold. Very few homes become legacy homes that generation after generation live in. It's just not the reality for most Americans. So the takeaway from today is plan, get informed, so that you can prepare to not only help you and your family, but again, if you should also talk to an estate attorney, a local estate attorney, about what happens when your parents pass away, and what happens with one of the biggest assets they usually own, which is home ownership. Again, if you have any questions, give us a call at 520-485-7371. If you're looking for a good CPA, we can connect you with ones that we know, or find a local CPA for you through our networking networks, or our networking networks. Yes. And you can always go to guardiantaxlaw.com and find these videos on our YouTube channel under guardiantaxlaw.com. Hope you have a great day. Hope you learn from this, and we will see you tomorrow.